What's a vendor take-back mortgage? A vendor take-back mortgage occurs when the vendor, the seller, is lending money to the purchaser, typically because the purchaser can't secure more financing to make the deal happen. Let's think of a specific example where we got a $1 million piece of real estate. $1 million piece of real estate. I'm the buyer. I can only come up with 50 grand. The bank is telling me I need to come up with $250,000 in order to get a mortgage of $750,000. I don't have $200,000. I'm short. I can't come up with the money. Mom and dad don't have that money. Auntie and uncle can't do it. I don't have access to that liquidity. This is where the seller would say, I will take a second mortgage on the property that I'm selling to you, and I will lend you the 200 grand. The 200 grand then forms part of the purchasing price. So the buyer would have the 50 grand deposit, the 200 grand vendor take back loan from the seller, and then the bank would lend the $750,000 to come up with $1 million so that the deal can happen. The buyer will also have to pay back the VTB loan, vendor take back, because that's also going to form part of their debt. They're going to owe that 200 grand to the seller. Now, those terms might be different from the mortgage terms. It might be payable over 5 years or 10 years. There might be different interest rate on that. Typically, one of two things will happen with the interest rate on a VTB loan. Typically, it'll be done at a low rate so that the buyer can actually afford to make these payments, or we'll sometimes see a subprime loan done at a much higher rate so that the seller is enticed to lend this money to the buyer. Vendor take-back loans are often thought of as a last resort for the buyer and for the seller, in that there's no other way to arrange the financing, and typically it's when there's only one buyer left for this purchase. The buyer really wants the property, can't come up with the funds, finds there's no way that they can do it. The seller really wants to sell, is convinced that the buyer will be able to make the payments, and is willing to take that risk on. Typically in a VTB loan, there would be some security arranged by the lawyers on the seller's side so that if ever the payments aren't made, the vendor can take back the property. It's a take-back loan in the event that the payments aren't made. So there will be security assigned, and depending on where the mortgage sits on here, but the vendor can often take back the property if the payments aren't made. So it does become a less riskier proposition. We often see VTB loans in business deals, in real estate deals, in commercial transactions, any large transaction, multi-million dollar transactions where the financing is tough to get in place and traditional financing can't come through. VTB loans are quite common in a commercial or a industrial or a multifamily deal where you're going to get a 20 or 50 or $100 million deal where there's less buyers, there's more incentive for the sale to happen, and there's a commercial aspect to it. So we know that there's cash flow coming in so that the buyer should be able to make these payments. And typically there'll be cash flow coming in from the rents collected on the property. VTB loans will often be seen in small business dealings where there's very limited buyers, and we're not talking about real estate now, we're talking about a true active enterprise. Maybe it's a small manufacturing firm or a small business that's generating revenue, is mildly profitable or somewhat profitable, and it's a key employee in the business. Let's say I created a business, I started it, I built it, I'm now ready to retire. I have a key employee, a manager of some sort, a senior manager, or perhaps a group of managers that are going to come in and buy the business from me, the owner. I'm retiring, they don't have the capital, they can't fund this payment, the bank's not going to lend them the money. Therefore, I'll say, listen, I believe in you guys are good managers, I've seen you in action for 10 years, you guys have worked under me for all this time, I believe in you, I'm going to lend you the money to buy the business from me, and I'm going to make sure that you pay me over time. I know the business is profitable. This will work. VTBs are often associated with groups of close contacts that either buy or sell a company, specifically key individuals that have grown up in the company often see VTBs. There you have it, guys. VTBs in real estate, VTBs in commercial transactions, and VTBs in businesses that are being sold across the board. The vendor take-back loan, very common, easy way for you as a buyer to increase your leverage. And as a seller, although it's an increased level of risk, it's a way for you to make sure that your business does get sold and you get that loan from the bank so you can actually retire. Thanks for tuning in, guys. We'll see you in the next video.